In the middle of this, we had gold hitting a 6-month high as investors are still seeking out some alternatives to stocks. The former commissioner of the U.S. Commodity Futures Trading Commission, Bart Chilton, with us now. Bart, what are you making of that? I mean, a lot of people, these gold bugs in particular, who often let us know their feelings on gold, think this time is real, that what's happening here is gaining traction. Do you agree with that?
Well, the gold bugs never stop letting people know what they think, and
That's
it's
right.
always too low, and it's always being manipulated, and the same with silver. But I think they have a point that now is a pretty risk-adverse time to get into gold. I mean, as you say, it's just a few cents, maybe 60 cents. I saw it hit 1287.10, I think, earlier today. So it's not that far off of that June 15th high that you're talking about, Neil. So it does seem to me like now's a pretty good time to be in gold, given all the market news. I mean, if you look around the world, Neil, it's not just in the U.S., but, I mean, in China, both, if you look at the composite, the Chinese stock index over there, 31% down. That's a combination of the Shanghai and the Shenzhen. That's the worst in the world. But markets all over the world were down. So it's not just unique to the U.S., Neil.
So I'm wondering, though, in an improving economic environment, let's say for the world, you could make the argument that that would presumably benefit gold as well. That's not been the case in the past. But is it fair to say that if we are too simplistic in our thinking, not you, but too simplistic in our thinking, what's bad for stocks will automatically be good for gold?
Well, I mean, Oscar Wilde famously had that quote, you know, expect the unexpected demonstrates a thoroughly modern intellect. And I think that's how you have to look at
He was a big gold bug, if memory serves her right.
Yes, that's right. He probably tweeted back then. But I mean, the point is that now more than ever, things are so different in markets. They're faster. We see flash crashes all the time because of the cheetahs, the automated traders, etc. There's more news coming in that can impact the market. When I was a regulator, Neil, my mantra was never move markets, don't say something. But that's been thrown out the window. I mean, the president impacts markets every couple of days, it seems. And so I think you have to look at all asset classes, including gold, bonds, stocks, futures, what I used to regulate, in a different light these days. And you have to be really risk adverse when you do these things, because otherwise you're taking a chance that something could go up or down in a quick hurry.
You know what worries me more about the environment today, Bart, is it happens so quickly, and these swings are so off the charts huge that it's not for the faint of heart. Now, I like to tell people that if you're a day trader, that's one thing, but if you're in the market for the long haul, or you're saving for your kids' education or your own retirement, you just buckle up for the ride, and it might be a crazy ride, but it all kind of, you know, evens out as time goes on. But it does seem particularly crazy. And what do you tell people who look at that, whether it's happening in the commodities arena or certainly with all the market averages where we have these 800 to 1,000 point plus swings? Is that just the norm now?
It is the new normal, and, you know, neither of us, you or I, are you know, financial advisors, but when we look at these things all the time, Neil, and to me, these fast-moving markets, and they are faster than they have ever been. I mean, when we did a study when I was back at the CFTC, at sometimes during the openings and the closes, when you see more trading, there were 400 to 500 trades per second in these markets. So these algorithmic traders, and they're not bad, they bring liquidity to the markets, but that means that markets are moving faster than ever. So as you say, Neil, it's not for the faint of heart. I think looking at these longer term, the sectors, I mean, all the sectors were down except for a few. Healthcare was up for the year, although they just announced that the 3 dozen healthcare companies announced that they are going to increase drug prices, hundreds of drug prices just today. So I guess that's how they make some of their profits. But by and large, when you look at the overall sectors, energy took a hit last year. You were talking just a moment ago about some of the FANG stocks, etc. I think looking at those baskets, the ETFs, the exchange-traded funds, and the ETPs, the exchange-traded products, all of those, to me, Neil, are things to sort of look at where there's less volatility in, for example, a tweet from the president about whatever it is, GM and Mary Barra shutting down plants, and all of a sudden the stock tanks. You don't want that exposure, to me at least. I wouldn't want exposure to something could happen and you're enormously adversely impacted. There's a lot going on in markets today, because people need to be careful.
Yeah, and if you spread your bets, you're less exposed to one particular moment. Bart, thank you very much. Happy New Year.
Happy New Year to you, my friend. Take care.
All right.